Hi, everyone. Welcome to our first quarter market update. Now, we decided to wait an extra week to let the constant flow of news simmer, but it doesn't appear to be ending anytime soon. And so here we are. A word from our lawyers, though, to start and moving along. I've decided to section the start of our presentation into two halves. The first of which is looking at where we were at the end of the first quarter, March 31st. And certainly, it was a very turbulent quarter driven by the conflict in Iran. As a result of that turbulence, we saw defensive areas of the economy perform relatively better. Those include consumer staples and utilities. But far and away, the best performers were those directly exposed to the conflict and beneficiaries of the rise in oil, gas, and commodity prices, which is energy and materials, the former of which was up over 38% in the first quarter of the year. Although 1 month later, we have a starkly different picture. Over the last 10 days, the S&P has risen by more than 10%, and the 11-day recovery in that oil-driven drawdown that we saw in March is one of the fastest on record. This recovery has been led by exceptional performance in consumer discretionary, tech, and communication services sectors, all exhibiting strong earnings growth, and the latter two, of course, having outsized exposure to AI, which we are going to touch on. The latest market turbulence, though, was entirely multiple driven, with a downward re rating of close to 3 turns, while the earnings backdrop, the denominator, remained relatively accommodative. So, while still elevated, we are now in a slightly better valuation backdrop than we were coming into this year. And as we always do, it is important for us to highlight the Magnificent Seven, which continue, as we see here on the chart on the right, to represent nearly 40% of the index. To date, the group has been relative price underperformers, despite, as we see on the chart on the bottom left, continuing to drive strong earnings growth. The latest batch of earnings releases in the first quarter of this year were largely positive, but there's continued debate around the deployment of capital to AI and the potential's return on that invested capital, and that has acted as an overhang for a few stocks in the Magnificent Seven. And that really brings us back to basics, which is AI. Now, while I just mentioned the Magnificent Seven stocks, the hyperscalers, which have underperformed slightly year to date, there's been little debate around the drivers of recent market performance, which being AI. The chart on the left shows exceptional year to date returns in AI bottlenecks across semis, hardware, and power, all backed by equally strong earnings growth. Software has been a particularly troubled area of the market as debates around potential AI disruption risk persist. We can also see the extent of this recent divergence in performance from the chart here on the right. Now, while many sectors are continuing to grapple with the oil shock, tech sectors have largely brushed it off in its entirety and have gone back to what was working before all of this began: AI. And as we said coming into the year, we are big believers in this theme. And you'll find our portfolios have investments across this theme. We just feel it is prudent to remain diversified across other areas where we see idiosyncratic or structural drivers of return. This allows us to remain well diversified. And now moving to ex-US equity performance. Ex-US markets were performing well prior to the oil shock, but have certainly given some of that relative outperformance back over the last 2 months. The energy independence of the US, especially compared to its Asian and European peers, coupled with its outsized exposure to AI, have left its market better off as of late. And this reaffirms our global asset allocation posture coming into the year. That is to say, we've remained well diversified globally, still exposed to the US market, about neutral weight, but remain structurally positive on ex US equities over a longer term horizon. If anything, the recent unilateral action against Iran has further evidence to European and Asian partners that a multipolar world is here to stay, and domestic investment, including around energy security, should remain a top priority in the years ahead. And that brings us really to the question that I'm sure is on everyone's mind is the war in Iran. Because really, outside of AI, we have a market unilaterally focused on one variable, oil. And I thought, what a better representation for the current status of the war in Iran than this carefully curated AI image, which really indicates where we're at, which is a stalemate. And so, further to that question of where are we now, as we see starting on the chart on the left, and to quote a favorite movie character of mine, you shall not pass. Despite the ceasefire on April 8th, Iranian control over the passage of vessels over the strait was met with a U.S. blockade of its own. This has effectively led to no shipments making its way through. There is now news of the U.S. providing military assistance to facilitate passage, and will observe the effectiveness of this operation, dubbed Project Freedom, closely over the coming days. Nevertheless, the current status of passage is far below where it was before this conflict began, which we see on the bars on the far left of the chart. And for what it's worth, as we spoke to last month, the market continues to see a relatively benign outcome from this war. Now, this would not be inconsistent with prior episodes of geopolitical conflict, but as we can clearly see, long end futures remain well grounded and have only ticked up slightly despite this war continuing to drag on. And I thought it would be important to highlight that really there are few viable alternatives to the strait. Pipeline and other terminals, such as the east-west crude oil pipeline that can redirect flows to the port of Yanbu on the Red Sea, has allowed Saudi Arabia to divert significant volumes, but most estimates now suggest that its capacity is maxed out. The UAE's Abu Dhabi crude oil pipeline can tack on some additional capacity, but it was in use prior to the war, and it too appears to be near or at capacity. In aggregate, it's estimated roughly 4 million barrels of oil have been diverted through alternative pipeline routes, all now near or at full capacity, and that represents only 20% of historical oil flows. We can see this more clearly on the chart on the right. Now, the release of sanctioned oils, oil stored on water, and strategic petroleum reserves have negated some of the additional rise in price that we would have otherwise seen to date. But that is not a permanent solution. And reserve releases in similar scale can likely occur 2 to 3 more times before being fully depleted. It will also take several weeks to fully restart production that's been shut in from the conflict, which have thankfully remained largely undamaged. So we clearly continue to operate in an environment that is untenable over the long term. And we, as investors and stewards of your capital, have to have humility. I don't think any of us, possibly even President Trump himself, know what his next Truth Social post will be. However, what we do know is how to view this conflict. And what I find best in these cases is to take a step back, view the facts through a constraint-based framework. This ties us back into our title slide. It appears that we are in a Cold War era stalemate. From Iran's perspective, and this has been wonderfully illustrated by Marco Papic, a leading geopolitical analyst, Iran does have leverage via the closure of the strait, but risks losing this leverage if the strait remains closed for too long and causes permanent economic damage. At this point, if there is significant economic damage, we are likely to see a significant military escalation, likely involving a coalition of countries. And as we see on the chart on the right, the US has actually kept its gloves off in the conflict to date. and was responsible for only a small margin of the total attacks against Iran and targeted primarily military and strategic installations. This could all change if the economic picture deteriorates and the incentives for negotiation are no longer on the table. And on the opposite side, the US is equally constrained. Politically, as we talked about in our first go round of the Iranian conflict, this is an unpopular war in a critical midterm election year. This is significantly impacting Republican odds, and we can see on the chart on the left that since March, the likelihood of Democratic control of both the House and the Senate has risen significantly. We can also see quite clearly from the chart on the right that the US does not presently have the military assets that would allow for a larger scale conflict or ground invasion, with very few troops positioned in the region. This is especially true as we now enter the extremely humid summer months where heat waves can reach over 50 degrees Celsius in the region. This poses its own set of operational constraints and logistical challenges, not only on troops, but also on equipment. And so, to conclude, we continue to feel that the odds, via those constraints that we just analyzed, both from Iran's perspective and the US's, favor an eventual resolution, which is what the market has priced in. However, we are watching carefully to see if we reach a point that becomes untenable. And certainly, the way we've analyzed the constraints is from a fact based approach. And not all actors might view this in a similar way. Not everyone is rational, which, of course, we have to consider. And most estimates I've read from oil and gas experts point to June or July as a tipping point in this conflict. And so we're likely to see heightened rhetoric in advance of that point. And now, to just frame this from a longer term view, which of course is our preference, the market goes down about 10% every 2 years, 20% every 3 to 4 years, and that's what we call in industry as a bear market. Volatility is frankly the price that you pay to stay invested. And it's been prudent, as we see on the chart, to stay invested, especially through times of geopolitical conflict. And if this war is to be fully resolved, I believe that we're operating from a very solid base. CapEx intentions, as we see on the chart on the left, are improving for the first time in several months, which, if continued, should be supportive of broadening participation in equity markets and economic growth from other areas than AI investment. On the chart on the right, as we continue to navigate the first quarter earnings season, we see that earnings growth has remained robust, with over 50% of the index having reported to date and around 78% beating estimates, which is in line with its 5-year average. Forward estimates of earnings growth, which is one of the largest determinants of forward return, remain high. And while AI exposed names are certainly doing some of the heavy lifting, in aggregate, this indicates an otherwise healthy corporate backdrop. And now, moving along to a review of the economic picture, both in the US and Canada, we'll start with the US as it presently is. Inflation trends are really where they were when we spoke a few months prior, in that they're settling slightly above target, and the Iranian war is not helping that picture, as an increase in fuel prices, of course, increase headline inflation. We also continue to see a very similar operating environment when it comes to US labor, both in terms of employers, where there's really no hiring or firing, and the supply of labor remains relatively constrained, largely as a result of recent immigration policies. And so the labor market's break-even rate for unemployment to rise is certainly lower than it was in prior years, but we're not seeing significant points of stress yet. And so that leads us to the interest rate picture. Now, coming into the year, it was priced in by both the markets and officials that cuts would be appropriate in the second half of this year. 2 cuts was the standard priced in at that time. The market has largely priced out those cuts for 2026, even though some officials continue to see some cuts in the second half of this year as appropriate. We will be having a new Fed chair, Kevin Warsh, likely to be taking the reins in the coming weeks, and we will closely watch his statements as far as it comes to public policy, even though he's given some to date. And now moving along to Canada, we see that the Canadian unemployment rate did experience a rebound after a fall earlier this year. Now, even though it has risen from a declining level in the first couple months of this year, we do see some scope for improvement as the year progresses, as we see on the chart here on the right, in that hiring intentions, which are typically a good leading indicator for employment, are beginning to tick up for the first time in several months. And from a Canadian inflation perspective, it doesn't appear to be a significant present concern, even though rising fuel prices are certain to impact the picture in the near term. Like the improved hiring intentions that we saw on the previous page, we also now see on the chart on the right a GDP picture that seems to be turning somewhat more positive based on business surveys. So the overall backdrop appears to be slightly improving, but it's important to caveat that with that there are continued critical overhangs. As mentioned, rising fuel prices can certainly have an impact on an already fragile Canadian consumer, and upcoming CUSMA negotiations are expected to act as a driver of significant uncertainty. We look forward to discussing the progression of this talks more in depth in our next presentation. But really, where that leaves us is when it comes to Canadian rates, I would expect those to remain about the same through the end of this year. We really don't see much scope for significant hikes until we get into 2027, especially with some of the overhangs I just touched on. This entails the currency picture that we think has a floor where we indicated coming into the year around 1.39 if we're looking at US dollar over CAD, or about 0.72 CAD over USD, and an upper limit for Canadian dollar appreciation slightly above 0.75. So not very significant volatility in Canadian currency markets. And so with that, I just want to thank you again for your continued time and attention to our presentations. We look forward to our next quarterly presentation, likely in July, but we'll be sure to have added commentary if there's additional escalation or resolution to the Iranian war in the interim. Thank you very much and have a great rest of your day.